You're listening to Pop Trends Price Culture, the podcast about mood and markets. Our episodes include strong opinions and occasional strong language. Government bond yields is a phrase that sounds like a good reason to take a nap. That's because governments are usually boring, bonds are usually boring, and government bond yields are especially boring since those yields, or rates of interest, those yields are usually the lowest bond yields of all. But please bear with me because I'm not going to talk about the boring stuff. This is a podcast, not an economics class. I can't make this topic sexy because that would probably be creepy.
Oh, Mr. Folsom, government bond yields? Yes.
See, that is creepy. And if I had to resort to sound effects, I'd go with something more like this. But instead, I'm going to use my words to tell this story because the financial media is not telling it. I'm not saying there's some conspiracy. The facts are all on the record. What I am saying is the media has failed to explain the larger story about what the facts mean. Big fact number one is this. For the first time in 50 years, maybe for the first time ever, 10-year government bond yields for the U.S., Japan, and the major economies of Europe are all below 2%. Why does that matter? Well, more than any other financial trend, when the bond yield trend goes this low, it casts huge doubt on the notion of a quote-unquote strong economy. This is not just any indicator. Bond yields and interest rates, which are flip sides of the same coin, they indicate how healthy an economy really is. The Federal Reserve's own mission statement says it's supposed to pursue quote-unquote moderate long-term interest rates. Well, yields below 2% on 10-year treasuries, that ain't moderate. That's extreme. So if anything, this decline in bond yields is a neon sign of deflation. Interest rates are, of course, different for different kinds of borrowing and lending. Mortgages, credit cards, and money markets all have different rates of interest. But in the financial world, the most closely followed long-term rates are government bond yields. And actually, you should expect the U.S., Japan, and Europe to have the lowest yields. They are the least risky. Their economies are the most strong and stable. These countries pay their debts. So, big fact number one is yields have fallen to historic lows. Big fact number two is this. The U.S., Japan, and Europe don't want yields to be nearly this low. As I said, we are talking about the major global economies. And when bond yields are this low, it means they're begging people to borrow in order to stimulate growth. Yet, borrowing has been sluggish for years, and the actual rate of inflation remains way below the Fed's target. Yes, the Fed has a target for inflation. Therefore, if the definition of interest rates is the cost of borrowing money, and if all major government bond yields are below 2%, then in a very real sense, money is on sale. And I don't mean a small sale. I mean an all-time rock-bottom sale. But almost no one is buying. So far, I've emphasized the world's major economies because that's where yields have fallen to 50-year lows. But in case you're wondering about other economies around the globe, this trend has reached nearly all countries. In the first 34 days of this year, Australia, Canada, Egypt, India, Pakistan, Peru, Russia, and Turkey all cut their interest rates. The Swiss National Bank recently dropped the Swiss franc's cap against the euro. This decision hit the currency markets like a tsunami. And if you can even find a news article about any of this, it'll probably include phrases like unanticipated, surprise, and against the consensus forecast. What that means is the experts didn't see any of this coming. And I'll briefly mention big fact number three, which is that money velocity is crashing. And this is crucial to the bigger picture. Money velocity simply means how quickly money changes hands. The Fed tracks this data very closely, and today, money velocity is the slowest it's been since the Fed started keeping data back in 1959. This is the opposite of what happens during a major inflation, when people spend money quickly because they're afraid a dollar will buy less tomorrow than it can buy today. But instead, in 2015, money velocity is crashing. The spending behavior of consumers and businesses is making money change hands more slowly than at any time since the 1950s. The one-word takeaway from this episode is deflation. If you want a 3-word takeaway, it's that deflation is spreading. Government bond yields are at all-time lows. Governments don't want yields to be this low, and the velocity of money has slowed to a crawl. In the next podcast episode, we'll delve directly into the deflation trend, beginning with the biggest misperception of what deflation actually is. And so I'll end now with what it's not, namely deflation is not falling prices. Prices are the effect of deflation, not the cause. So please do tune in next time. You'll learn all you need to know about how people cause deflation via a very specific pattern of collective behavior. And thanks for your time. I'm Robert Folsom. P.S. If you like what you've heard, please subscribe on iTunes or via your Android app of choice. It's free. And especially give us a favorable rating on iTunes. That's the best way to ensure we can continue to produce pop trends, price culture. Thanks again.